Hi, my name is Christian Waldegrave, Head of Research at Teekay Tankers, and this is our tanker market update for June 2022. Well, looking at spot tanker rates over the past month or so, we've seen a very unusual situation emerge in that the market has essentially been inverted, with product tanker rates being higher than crude. And then within the crude segment, the Aframaxes have been the best performer, followed by the Suezmaxes, and then the Vs have been the worst performers. Now, on the product side, I think what we're seeing is very strong fuel demand heading into the summer here. It's really the first summer in 3 years that people have been able to travel because of COVID. So we're seeing very strong demand for especially gasoline and jet fuel. But at the same time, refined product inventories are very low. And in the Western Hemisphere, what we saw during COVID was the shutdown of around 2 million barrels a day of refining capacity. So now that refined product demand has come back, there isn't enough refining capacity in the West to meet demand. And that means that a lot more refined products has to move long haul from east of Suez, places like the Middle East and India, to bring fuel into the Atlantic basin. And that's really been supporting product ton-mile demand. On the crude side, what we've seen is that the mid-sized tankers continue to be supported by changing trade patterns as a result of Russia's invasion of Ukraine. Looking at what's happened so far with Russian exports, the sanctions haven't really impacted the volume of Russian oil exports. If anything, actually, Russian exports are up compared to pre-invasion levels because domestic refinery throughput is down, so there's actually more crude available for exports. But that oil is definitely moving longer haul. Less of that Russian crude is going into Europe, and more is going into east of Suez, so especially India, but also now China. And that's creating a lot more ton-mile demand for Aframax and Suezmax. And then at the same time, Europe's having to buy its oil from further afield to replace Russian barrels. So we're seeing more oil coming from the Americas, so US Gulf, Latin America, and also West Africa up to Europe. And that's really been a positive for mid-sized tanker ton-miles. Unfortunately, the VLCCs have not been faring so well, and rates have really sunk back to rock bottom levels in the VLCCs. And that's really due to, I think, the main reason is that the lockdowns that we've seen in China, the COVID lockdowns over the past 2 to 3 months. At one point, at its height, around 350 million people in China were under some form of lockdown. And that obviously led to lower Chinese oil demand and therefore lower Chinese crude oil imports, which really hits the VLCCs more than any other sector, given that around 1/3 of VLCCs typically discharge in China. And what we've also seen as well is because oil demand has been stronger in the Atlantic versus the Pacific, the crude pricing in the Atlantic has been quite high compared to, say, Middle East crude pricing. And so there hasn't really been as much incentive to bring oil long haul from the Atlantic to Pacific. So that combined with the COVID lockdowns in China have really harmed the VLCC market. And that means in turn that a lot more Vs are coming into the Atlantic basin and competing with Suezmaxes out of West Africa, for example, going up to Europe, which is kind of capping the mid-size rates. Looking ahead, though, we are quite hopeful that the situation in China is going to improve. We see that Shanghai and Beijing are both now starting to emerge from lockdown. So that should improve Chinese oil demand and oil imports. And just in the last week or so, we have seen VLCC rates starting to come back up. So hopefully that's a positive sign that that market is starting to recover. However, there are some headwinds on the horizon in terms of a slowing global economy, high oil prices, and maybe even the potential for a recession, all things which typically are negative for the tanker market, particularly if we get a recession. That obviously means less GDP growth, less trade, and that usually means less oil trade volumes. But there is some reason to believe that this time around the market might be able to weather a recession a little bit better than in prior years. Firstly, as I said, we are seeing longer voyage distances due to the disruptions caused by Russia's invasion of Ukraine. Secondly, oil demand itself is holding up relatively well despite high prices at the pump. And the IEA is forecasting just under 2 million barrels a day of oil demand growth this year, and a little bit more than that next year, which is positive. And then the third factor is the fleet supply side, which continues to be very positive due to a lack of ordering, a small order book, and an aging tanker fleet. And I highlighted some of these factors last time, but I really want to concentrate on the lack of tanker orders. If we look at new build ordering this year, there's only been 1.7 million deadweight of tankers ordered through the first 6 months of the year. So around 3.5 million deadweight on an annualized basis. And if we look at the history of tanker orders right back to 1970, this year is shaping up to be almost the lowest year ever for crude tanker for tanker orders. You have to go back to the late 70s and early 80s to see these low-level types of orders. So that's really positive from a fleet supply perspective, because it means when we get into 2023, 24, 25, there's really not much of a tanker order book. And I think that situation is going to persist because, if we look at new building prices, they're the highest since 2009. Shipyard capacity is very tight through to maybe late 2025 because of all the container ship and dry bulk orders. And so I think there's going to be a continued lack of ordering, which, coupled with, as I said, the aging fleet, means that we're probably going to move to around zero fleet growth next year, and probably negative fleet growth for 2024 and maybe even 2025 as well, because I think the level of removals of the older ships will outweigh the new ships coming into the fleet. So summing up, I think we remain somewhat optimistic on the near-term outlook for rates. As I said, we do need that VLCC market to recover if the rest of the crude sectors are going to be strong. But it does look like we're starting to see some recovery now with China pulling out of COVID lockdowns. And while there are some headwinds on the horizon in terms of a slowing global economy, we think that the longer trade routes as a result of Russia's invasion of Ukraine and the low fleet growth should ensure that the tanker market does start to show some more strength in the coming months. And then particularly as we get into 2023, and as I said, 2024 on the very low fleet growth or even shrinking fleet growth as we get into those later years. So that's our outlook for the conventional tanker market for June 2022, and we'll speak to you again next month.